Family, what's good? Welcome to Doctor's Financial. If you're stopping by the channel for the first time, my name is Dr. V. In this video, we're going to be going over Stocks 103 in the Stock 100 series. There's 37 courses. I'm on my Merrill Edge. I'm in Merrill Edge. There's 37 courses, and we'll be going through all 37 of those in different videos. Make sure you go ahead and subscribe to the channel. If you get anything from the video, definitely hit that like button for me. Comment down below. Most of all, share this with others, especially new investors or those who are interested in investing. Before we get into the Stocks 103, I quickly want to go over what the market has been doing and continue to stay on the message and the theme that I've been talking about for the last few months. Grabbing the dips whenever they occur in our industry leaders and ETFs that follow the S&P and the NASDAQ, the QQQ, which follows the NASDAQ. Right now, in this season of investing, this is what, especially the new investors, what we should be doing. Now, if you want to go out, you want to go ahead and try a few of the more speculative plays, of course, that's good. Some of the ones that I like SoFi. That's a growth company that has some ups and downs ahead, but I think we'll do well in the long run. You have NEO. NEO has some ups and downs going forward, but I think it's going to do well in the long run. Penny stocks, I'm not really doing any penny stocks right now just because of what I'm seeing in the market. Of course, I'm not a financial advisor. Consult your financial advisor if you do decide that's something that you want to do. But back to the markets, we can see what the Dow has been doing. The S&P hit an all-time high on yesterday. We can see it was way up there, closed at on yesterday, closed at 4,528. So we can see the S&P is just moving. I believe it will be approaching 5,000 within the next year to 18 months. So I believe the S&P will continue to go up. We can see that the NASDAQ has been on a tear. It hit an all-time high on yesterday, and I believe the NASDAQ definitely has more room to run. I remember just a few months ago, I was hoping that it could get to 14 and sustain it. Now it's well over 15 and continuing to make all-time highs. That's why it's important to buy dips whenever you see these slight pullbacks, these slight retracements from the all-time highs. Go ahead and buy. Don't let those red days concern you. What you should be buying: industry leaders, preferably in the tech sector. That's what I like. I like Apple. I like Microsoft. I like Amazon. If you can buy slices or fractional shares, or if you can afford it, buy full shares. I like Google, all of those big tech companies, of course. I also like Nike. I like Home Depot. I like industry leaders in the, right now, and ETFs that's following the S&P. All right, I'm not going to beat you up with any more of that, guys. If you've been following me, you know those are the type of companies that I like. Dollar cost average into them. You cannot go wrong. Let's get into Stocks 103, investing for the long run. As new investors, I believe this is what we should be doing for sure. All right, what we'll learn in this lesson: volatility of single stocks, volatility of the stock market, and why stocks perform the best. And at the end, we'll be taking a quiz. All right, volatility of single stocks. Individual stocks tend to have high volatile prices, and the returns you might receive on any single stock may vary widely. We definitely know this. If you invest in the right stock, you could make bundles of money. That's what we're here. That's what we're in it for. Here is an example. In this example, they're talking about Monster energy drink. I don't know if you guys drink Monster, but it does get you hype. I used to drink it a lot, especially before a workout. But Monster does get you hype. Back in 2017, that 15 years prior to 2017, Monster did the best of any company within the S&P 500. But also, if you remember back in 08 when we had the big financial collapse and everything, when Lehman Brothers went under, and a lot of those other big Wall Street companies and banking and finance companies took a hit and got bailed out, all of that good. I don't even want to get into that. And Merrill Lynch was actually bought by Bank of America for pennies on the dollar. Now, these are two extreme examples of how a company can go to zero or how a company can make you a bundle of money. But what they're saying here, most stocks aren't like this. Most stocks fall somewhere in the middle of those two extremes. Most stocks don't double in the upcoming year, nor will they go to zero. Most stocks you won't hit a home run in, and most stocks won't go bankrupt. But the typical fluctuation from a 52-week high and a 52-week low for the stocks on the New York Stock Exchange is almost 40%. And I want to pause right here and just point something out, because not only do we invest for the long term, but we do some trades. Now, when you're doing swing trades, you're not going to be able to time the market perfectly and catch it exactly at the 52-week low and get out at the 52-week high. But we can see the average typical company has a 40% swing. If we can get near the low, 5-10% away from it, 15% away from the low, and buy at that point, and also sell. You're not going to be able to always know the exact 52-week high. But if you can get 5-10% within that high, there's a lot of money to be made in that 20-30% cushion that I'm talking about. Not the extreme low, but somewhere near the low, and not the extreme high, but somewhere near the high. And that's why it's important for us to learn how to do due diligence with the charts, learn how to use the moving averages, learn how to use RSI, MACD, all of those things to make us better traders. And also it'll help with your long-term investments too, because it'll give you the technical analysis will give you a good price indication of where to get in for your long-term trades also. All right, let's get back into this. In addition to being volatile, there is risk that a single company's stock price may not increase significantly over time. Here, this was, I guess this lesson was made in 2017. They're talking about JCPenney. We all know JCPenney actually went bankrupt and the stock price went to zero basically. So, but here they're just saying how a single company over time can actually lose money. And that's what happened with JCPenney. And you could have clearly seen even back then when this was written that it was going to zero. So it's very important that we know which companies that we're investing in and also have a great investment thesis of what we want those companies to do, and not just buy something and cross your fingers. I see some of that going on, hoping that somebody just comes on top and then bump the price up for you so that you can get out and make some money. That's not the best way to trade or invest, family. All right. Okay, we got our first question here. The average yearly difference between the high and low of a given stock is about 40%. We just read that. We know that is true. Volatility of the stock market. One way of reducing the risk of investing in individual stocks is by holding a larger number of stocks in a portfolio, i.e., being diversified. However, even a portfolio of stocks containing a wide variety of companies can fluctuate wildly, especially if all of those companies are within the same sector or even more within the same industry. Just because you hold 5 different EV companies doesn't mean you're well diversified, because if EVs go down in general, you're going to have a big hit. You may experience large losses over short periods. Market dips, sometimes significant, are simply part of investing in stocks. It's actually a great part. The market dips are our opportunities to buy. Buy the dips, hedge on your dips, learn how to hedge, and then hold for the long term. That's my thesis. That's how I invest. Despite the short-term volatility, stocks as a group have had the highest long-term returns of any investment. When the stock market has crashed, it has always, not sometimes, not most of the time, it has always rebounded. Whenever there's a crash, the stock market has always rebounded. Please know that and understand that and take advantage of that. History gives clues. For example, consider the Dow Jones Industrial Average, a basket of 30 of the most popular and some of the best companies in America. If during the last 100 years you have held an investment tracking the Dow, there would have been 10 different occasions when the investment would have lost 40% or more of its value. 10 different times they had a huge crash. That's basically what they're saying. Unlike this section here, the yield returns in the stock market also fluctuate dramatically. The highest one-year rate of return of 67% occurred in 1933, while the lowest one-year rate of return of negative 53% occurred in 1931. This was written before what happened in 2020 because 2020 was a monster year. It is obvious by now that stocks are volatile, but what I do want to show with this, you see the market fell 53% in 1931. And then right 2 years later, it had the best year ever for the next, 70, 75, 80 years up until 2020. 90 years almost. So please understand that when the market falls or crashes, it always bounces back. Over the long term, stocks are best. Despite all of the short-term risk and volatility, stocks as a group have had the highest long-term returns of any type of investment. That's important for us to remember. If you had deplorable timing and invested $100 into the stock market during any of the 7 major market peaks of the 20th century, that investment over the next 10 years would have been worth $125 over inflation. So you would have made basically, if you were to invest at the worst time and you invest exactly at the high. Remember, in my opinion, investing at the worst time actually is buying a stock at its highest, not when you buy a stock at its lowest. Buying a stock at its lowest is investing at the best time. When the market seems bleak and dim, when there's blood in the water, as they say, when others are fearful, in my opinion, that's the best time to invest. Now, it would have been worth $125 after inflation, but it would have been worth only $107 had you invested in bonds. So that's just going to show the difference. You can invest at the worst time in stocks and it's still going to be better than bonds over the long run. And $99 if you would have invested in government treasury bills. So you'd actually lost $1 when you consider inflation. In other words, stocks have the best performing asset class over the long term, while government bonds in these cases merely kept up with inflation. Actually, inflation, when you factor in inflation, sometimes you're actually losing money. This is the whole reason to go through the effort of investing in stocks. Again, even if you had invested in stocks at the highest peak, i.e. the worst time, your total after inflation returns after 10 years. You got to have a decade timeline, at least in my opinion, a 5-year timeline, but even more important, a 10, 20-year timeline when you're buying a company, when you're buying a stock. Time is on your side. Just as compound interest can dramatically grow your wealth over time, the longer you invest in stocks, the better you will be. With time, your chances of making money increases, and the volatility of your returns decrease. Over time, the volatility shrinks, it decreases, and we begin to make money when we're investing in the right companies. Now, the compound interest video was Stocks 102, and that was the August 2nd video. You can go back through my videos and check that one out. And then Stocks 101 was on July 29th. This is Stocks 103. Some numbers to illustrate. From 1928 to 2019, the average return on an S&P stock index, including reinvested dividends for a single year ranged from negative 43 to positive 54, with an average about 10%. So from 1928 to 2019, it's been about 10%, which is awesome. If you can get 10% on your money a year, dollar cost averaging in, depending on, you can go ahead and get the investment calculator and easily find out how many years it'll take you to become a millionaire. And you can use, say, $7,000 a year, break that down monthly, because I say 7,000 because that's what you can, the max out your IRA is 7,000. Max out your IRA, that's 7,000, and just into an ETF year after year. You don't have to know anything about investing to do that, and you can still, over time, become a millionaire. These returns easily surpass those you can get from any other major types of investments. Again, as your holding period increases, the expected return variation decreases. The longer you hold it, the variation of expected returns decreases, and the likelihood for a positive return increases. This is why it's important to have a long-term investment horizon when getting started in stocks. As a tax term, an investment held for more than 1 year. Actually, for me, long-term when it comes to investments is actually 5 to 10 years, preferably the 10 years and going forward. Really quick, let's look at, and I'll get right back to it. I haven't done this in a long time. Looking at an investment calculator, we're starting off with no money. We're going to look for 30 years. We just saw the S&P can give us 10% a year, compounded annually. You're going to let's say $7,000 at the beginning of every year. And let's see where we are. It's not magic, folks, to become a millionaire. Max out your IRA. All you have to do is buy a S&P 500 following ETF. By the time you retire, you're a millionaire easily. And that's not even factoring in some of the other plays, like when you do buy an Apple. Some of the other plays, like when you do buy the Home Depots and you're getting money into your brokerage account. This is just the IRA. This is just maxing out your IRA into an ETF. You don't even have to ask what to buy. IVV, VOO, SPY, SPLG, something that tracks the S&P 500. All right, I just wanted to show that to show how easy it is to become a millionaire. You don't have to know much about investing to do that. Now, let's get back to the course. We have another question here. If you are investing for your retirement that is more than 10 years away, based on historical returns in the 20th century, what percentage of the time would you have been better off by investing only in stocks versus a combination of stocks, bonds, and cash? Over 10 years, stocks is better, always. Correct. 100% of the time, stocks have returned more than bonds and cash after any 10-year period. That has been true even if you had the misfortune of investing at only the market peaks. Even if you invest at the wrong time, if you wait 10 years, you're still going to be bonds or cash. Important to know that. 10 years. Let's start saying that to ourselves. 10 years. 10 years. 10 years. When you buy Nike, you're holding it 10 years. Apple, 10 years. Why stocks perform the best? While historical results can certainly offer insight into the types of returns to expect in the future, it is still important to ask the following questions. Why exactly have stocks been the best performing asset class? And why should we expect those types of returns to continue? In other words, Why should we expect history to repeat? And of course, we always hear past performance isn't a predictor of future results, but we know over time, we've seen it time and time again, and they're going to explain it here. Here's why. Quite simply, stocks allow investors to own companies. When you buy a stock, you own the company that have the ability to create enormous economic value. Stock investors have full exposure to this upside. For instance, in 1985, would you have rather loaned Microsoft money at a 6% interest rate, which is good? If so, you loan somebody some money, they're going to give you 6% back. That's good. That's what the banks are getting. Or would you have rather been an owner, seeing the value of your investment grow 700-fold? Of course, you would rather have invested in Microsoft than bought one of their bonds at 6%. Because of the risk, stock investors also require the largest return compared with other types of investors before they will give their money to companies to grow their business. More often than not, companies are able to generate enough value to cover this return demanded by their owners. Not any company, but good companies. Definitely learn how to go in, do the fundamentals, learn the different ratios. I'll be going over it in this class. Definitely make sure you subscribe so you don't miss that course. Bondholders don't enjoy that potential. Meanwhile, bond investors do not reap the benefit of economic expansion. So when a company does better, if you have bonds in that company, it doesn't matter, because whatever the percentage is you bought that bond at, that's the percentage you're going to get. Your theoretical loan to Microsoft yielding 6% would never have yielded more than 6%. Microsoft could go up 1,000,000-fold. You're still only getting 6%. No matter how well the company did, being an owner certainly exposes you to greater risk. Of course, if the company tanks, you tank with it. And volatility. But the sky is also the limit on a potential return. So that's why I like stocks well over bonds. I probably won't really be getting into bonds until I'm well into retirement, and I just don't want any more volatility in my accounts. I believe in investing into the market even as you approach retirement, and getting in retirement in some cases when you have a 10-15 still have that 10-15 year time horizon, and you're just getting into an ETF that follows the S&P. So that's even when I'm 60, even when I'm 65, I'll still be buying S&P ETFs. Still be buying if it's around QQQ to follow the NASDAQ. All right, a very promising company that is seeking investors. It is paying a 7% interest rate on its bonds. It is also selling stock. Historically and statistically speaking, which would be the best bet for an investor? The stock. We just read that. Correct, the stock. Although we cannot predict the future, the stock will statistically be the best bet. Still, it is best to study the company's financials before investing. Very important. This doesn't just apply. You can buy any company. You have to definitely study the financials before investing. Alrighty, the bottom line. While stocks make an attractive investment in the long run, stock returns are not guaranteed and tend to be volatile in the short term. That is why advisors do not recommend that you invest in stocks to achieve your short-term goals. So if you want a lot of people, if I hear them, they ask me, man, I just need to make some quick money. I need to turn this into this or do this into this. That's not the stock game. You can try it with options, but you probably trying to time the market, in my opinion, is a fool errand. You can learn how to do some different option strategies and possibly make some money doing that. I have definitely made money with different option strategies, with the wheel option being one, credit spreads being another, put credit spreads being another. Now, some other different option strategies that you can learn and try. But if you're a new investor, nothing beats buying and holding a great company or an ETF that tracks great companies for the long term. Now, let's finish this up. To be effective, you would invest in stocks only to meet long-term objectives that are at least, they're saying, 5 years away. Me, let's double that. Let's say 10 years away. And the longer you invest, the greater your chances of achieving the types of returns that make investing in stocks worthwhile. All right, family, what we have learned was volatility of a single stock, volatility of the stock market, and why stocks perform the best. Let's go in and take this quiz. I'm going to give you all a chance to answer them first, and then I'll go back and answer them. Choose wisely. There is only one correct answer. A very promising company is seeking investors. It is paying 7% interest rate on bonds. It is also selling stocks historically and statistically speaking, which would be the best bet for investors. We just answered that one. You guys are going to definitely get that one right. The average yearly difference between the high and low of any given typical stock is about. We answered this one also. You should get that one right. So that's a true or false. You should definitely get that one right. If you were investing for your retirement that is more than 10 years away, based on historical returns in the 20th century, what percentage of time would you have been better off by investing in stocks versus a combination of stocks, bonds, and cash? We just answered that one. The average yearly difference between the high and the low of a typical stock is between, we just got that one right. And stocks are such winning investments that they have had the highest long-term returns of any type of investment. So we know that's true. Remember, it was 40. 100% of the time stocks. 40% was true. And you definitely want the stock over the bond for the long term. Let's submit this. I hope we all got that 100 and aced it. Let's take a sneak peek at what's next. Stocks 104. Introduction to stock, what matters and what doesn't. This should be a very good one. This should help us to eliminate some of that noise that we hear. All right, family, I'm going to end it here. I hope you got something from the video. If you did, don't forget, hit that like button for me. Thank you for rocking out with me through another video. I know this one went kind of long because I went through the whole section in stocks 103. Hit that notification bell if you are subscribed to make sure you don't miss stocks 104. I'm going to be finishing this video with a prayer, and if you would like, you can go ahead and pray with me. Gracious Heavenly Father, thank you so much for all you have done for us. Continue to bless your family. Bless us with wisdom and knowledge so that we can do well with all of our investments, Lord God. Bless our families for generations to come with financial freedom and financial independence. Bless us so that we may be a blessing to others. May our cups runneth over. In Jesus' name I pray. Amen. Family, be blessed.